Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott Asset Management. I'm pleased today to welcome a new guest to our podcast, Justin Tolman, Managing Partner, Senior Portfolio Manager, and Economic Geologist at Sprott. Justin joins us today with over 2 decades of global mining and exploration experience. Justin, thank you for joining Sprott Radio.
Thanks, Ed. It's nice to be here.
Well, Justin, as a new guest to Sprott Radio, I think it'd be best to really start off talking a bit about yourself and the work you do at Sprott and your overall experience.
Of course. Today, I'm a portfolio manager across a number of products at Sprott with my peers, but I originally started as an analyst here 6 years ago or so. A unique little wrinkle on the portfolio manager aspect of the Sprott business is the background before that, where I spent the previous 20 years, like you said, making discoveries around the world, working in mines, underground, open cut, developing projects, running teams, basically doing all the things that help to make companies a success in the metals and mining business, which gives me a lot of insight when it comes to selecting stocks to invest in and helps us go a lot deeper with our due diligence when we're looking at potential investments.
You know, some of the parts of the world you've visited, some of the more interesting sites you've been part of, give us a few highlights, if you would, to some of that experience, where you found yourself, what was interesting about it. If you don't mind talking about that, I think that would be really interesting for our listeners today.
I've been fortunate enough to be part of discoveries on 3 different continents over the years. I was part of the discovery team when I was working with Newmont for a gold deposit in Eastern Australia, which is on the cusp of just being greenlit now. I was the general manager for a junior explorer, which made a large porphyry discovery in the Andes, and at the same time had an epithermal discovery in the Desierto Massif in Argentina, both of which were acquired by larger companies.
You mentioned something I thought was kind of interesting. You just said, you're in Australia working on a unique discovery that's just being greenlit now. What was the time frame of that from point of discovery to point of extraction? It could be sometimes a decade or longer. Maybe walk us through that process, what that actually looks like.
A decade would actually be lightning speed at the moment, I fear, my friend. And the answer is always, it depends. Averages are actually a horrible way to measure this because there's a whole legion of ways in which projects can get stalled and fail to advance. And really good ones normally find a way, but not always. From discovery, it takes time to drill something out, to put it through its phases. But the real wrinkle we're dancing around is permitting and how that changes in a jurisdictional sense from country to country. And understanding of that is critical. And it's all too easy to try to blanket a company with one particular set of biases. In many cases, it's more of a patchwork quilt with individual provinces or towns quite willing or quite unwilling to support project development, depending. That includes here in the US.
Are there parts of the world that, regardless of how unique the discovery is, that they're typically kind of do not go type of places? Or are we willing to go all over the globe looking for opportunities? Are there just safer places to go versus others where you're going to get not just a return on your money, but a return of your money? Talk about that a bit, because I'm sure there's a geopolitical aspect to this as well.
The short answer is yes. In terms of how I think about that stuff, by and large, I'm quite agnostic with respect to country risk. I'm more than willing to consider what some would regard as risky jurisdictions, but it always comes with a couple of caveats. The potential reward has to be worth the risk, which is to say the underlying ore body needs to be spectacular sometimes rather than just good. And just as importantly, the management team can have a huge influence on the outcome. Where you've got management who are able to navigate the political waterways, the local politics, the ins and outs, can be the difference between a project succeeding or failing. And That applies whether it's somewhere quite well developed in the south of Spain or somewhere in a very emerging jurisdiction in the Democratic Republic of the Congo. And you need a different jockey for a different horse each time. But with the right team and the right project, I would be comfortable in a surprising number of places.
And speaking of teams, do you find yourself then like really following the talent around? I'm assuming CEOs sort of move around over time. Maybe management teams move around over time. Do you tend to favor the people over the geology, or the opposite, geology over people?
I think of it more like a three-legged stool, where management would be one leg of the stool and the geology would be the second. And on the third, you've got the corporate structure of the company. And a stool can't stand on only two legs. You need all three to make it work. So it's not a case of one over the other. If something's missing, you're going to fall over. In answer to the first part of your question, absolutely. I have a list of people through my time in the industry who I regard as best in class, who've been serially successful, who understand where the limits of their circle of competence is. And when they go to a new project, it behooves me to pay attention and follow them. So
a lot of investors we talk to tend to avoid or shy away from mining in general. It just seems too complicated. Too many things can go wrong. But with the right amount of due diligence, it seems like you can really get it right. What are some of the key factors you look for when you're evaluating a mine?
The answer is the number of ways projects can fail are legion. And arguably, they're all key factors. When I go out to a project for the first time, and one of the things that I think we do well here at Sprott that differentiates us is we do go out and visit sites, and we do try to get there as early as we can in the life cycle of a company. I'm looking at everything, and for the benefit of my own time management, what I'm often trying to do is find a reason not to proceed, to not invest. Mm-hmm. The faster I can get there, the more time I've saved myself. That starts before we even get on the ground. It starts at a desktop level. But if I can't find a reason not to do it, it gets elevated to the next level of due diligence and so on and so forth. It's kind of a trite answer without actually giving you a list of things other people can do, but something as simple as where's water coming from is an easy one, but at the right part of the world or the wrong part, if you go to the Atacama Desert, it can be more expensive than gold sometimes.
Well, that brings up a great point. All the different risk factors that are out there, in this kind of modern world of technology where you can kind of pull everything up on your screen. How valuable do you find it then to physically go see the site and really understand what the site is made of and the people that are involved? How much value do you put on that today versus say 10 or 20 years ago when you first got into the industry?
I don't know that the visit has gotten more or less valuable. Perhaps what's happened is with the accumulation of scar tissue, I've gotten better at asking the right questions and trying to glean as much as I can from it. But the site visits are critical, notwithstanding the idea that you can see a lot of the hard stuff we'll talk about, where a power line might go, how the topography might hurt or hinder an operation. There's a bunch of soft benefits. Being in the car on a bumpy road with management for 8 hours, at the end of that time, you know not just the ins and outs of the project and management's history, but the names of their kids and all sorts of stuff. And that kind of access is impossible to get otherwise.
What are some of the technologies out there that you've seen change to make this industry safer, more productive, better, more cost-effective? What are some of the things you've seen change in the last couple of decades in this business?
What a wonderful question, Ed. In no particular order, I would point out the rise of remote use of trucks and machinery underground, which means that operators are no longer in dangerous situations. They're not in hot or noisy or gassy areas. And that flows through to the rise of autonomous truck fleets, which is increasingly being used. On the exploration front, we've seen incremental improvements in a whole range of geophysical and remote sensing tools. There's a couple of new techniques looking at improving the turnaround time for assays, which if you're in a remote field camp with a limited field season, the idea that you can get a gold assay in less than 24 hours rather than having to wait 4 weeks or sometimes even more in peak times has huge implications for the timeline to discovery. What we haven't seen is great big step changes, but we've had a lot of incremental benefits which combine to make us better at what we do, both from a productivity standpoint and, as you said, from a safety standpoint, which is arguably even more important.
Have you historically looked predominantly at precious metals as a whole, just mostly gold and silver? Or are you getting involved with all kinds of mines now, from uranium to copper to all the battery metals, rare earths out there? What's going on in that space? And is it any different, or is a mine a mine? Does it really matter what they're actually pulling out of the ground?
I've worked in precious metals, but I spent a lot of time in base metals as well. I worked in uranium, I've worked in coal. So I look at all those commodities. In addition to my activities on the precious metal side of Sprott, I'm also a co-PM on our energy transition fund. And the mandate stretches across exactly what you're talking about: copper, nickel, lithium, all of the exciting sort of metals that are going to help drive the energy requirements we have for the future, the electrification of everything. Part of my brief is to go out there and identify the best projects and, be part of them going forwards.
As a portfolio manager in this space, how do you try to guard against things that can go wrong, things that kind of go bump in the night? And what are those things? What are the two or three biggest risk factors out there when looking to invest in a mine from a PM's chair, from a PM's point of view?
The first one actually has little to do with the commodity itself. And I would suggest we need to look really carefully at dilution. The idea that these companies don't operate in a vacuum. Mines are not cheap to build. Exploration is never free. If you're not careful, you can do everything right and still lose because dilution came to eat your lunch and the share price wasn't appreciating as fast as the company was issuing new shares, which is one of the reasons that I don't really push market cap as an indication of value. I look at share price and how that changes over time. The other thing that springs to mind is obviously we can't control where the mineral deposits are located. So our host governments have a huge influence over how fast a project gets developed and whether or not something goes bump in the night, to use your words, Ed. Thinking about how you mitigate that risk and the hazards of sometimes it's outright nationalization, like we saw in Kyrgyzstan a few years ago. Sometimes it's creeping nationalization, ongoing changes to the mining code that you thought was settled and turns out they'd like to come back and reopen that discussion again. How you stay on top of that is, part of being engaged and following your investments, but following the countries that you invest in as well and understanding that it's never going to be perfect. You can always be blindsided. So then it comes down to position sizing, making sure your investments are balanced across a range of things and sized accordingly.
And you talk about nationalization, as we have more and more conversations with large institutions and advisors and investors and even direct investors, we talk about the whole supply demand of a lot of these different metals. And one of the responses always is, well, if it becomes so tight, won't they just nationalize that mine and try to keep the prices in check? I think that maybe is not the right way to understand what nationalization actually means. Can you just, for our listeners, talk about why would a mine get nationalized and what does that actually mean and how real is that risk when looking at investments?
Where I feel that there's going to be a strong risk of nationalization, that's a pretty easy avoid. And that's where the government comes in and decides it can maximize the value to the country by developing an ore body itself. And for that government, it might not be about profit per se. It might be about having as many jobs as they can, which is one way to think about it, but it's not how shareholders would think about it.
Right.
And historically, that's never worked. Maybe it has somewhere. Maybe one of your listeners can point out to me where it's been a net positive. But I somewhat cheekily referred to what I call creeping nationalization, where the government increases its take of the value of the resources in the ground, either through additional taxes, additional royalties. Increasingly, we're seeing a trend towards partnership with governments. And on an individual mine, companies will sit down on projects of importance and say, let's find a situation that we can all live with. And they'll look at the total take from the mine, not just taxes and royalties, but salaries, investments in, local infrastructure, all of the revenue that gets generated, and make sure that split is equitable so nobody feels like they've been exploited, neither the company nor the locals nor the host government. And the rise of that, I think, has been a tremendous net positive, and it's actually unlocked a bunch of mining operations or potential mines which might otherwise still be trapped in glacial ice today. In the past, as an industry, we've done a poor job perhaps communicating to different stakeholders exactly what our real costs of business were. We used to report just cash costs, and it would be easy if you're a host government or a naive investor looking at that going, these guys are making a huge margin. This should be making a killing. And if you're the government, you're asking, well, where's my proportion of this? What am I getting on that? And we all know that that's not the case. Mines have large sustaining capital needs. Businesses have G&A. You have to service debt. So being as upfront and clear as you can with everybody, all the stakeholders about that, minimizes misunderstandings going forwards.
People think of mines as destructive to communities. The reality is probably the opposite. They're in beautiful parts of the world. They're in parts of the world that maybe there's not economic opportunity. They bring that economic opportunity to that part of the world. We're self-serving in saying that for sure, but what's your take on that? Have you seen many projects where you can have both? You can have an ecosystem functioning and thriving and have a mine existing and being profitable? Is that a reality? Can we actually see that happen?
Absolutely. And happening. I think most geologists and people who are on the ground early are environmentalists at heart. We took this job because we like and respect and want to be part of nature. When I became a geologist, part of the attraction was that I'd get paid to go camping. Yes, absolutely, mines have an impact, but it's contained, and modern mining goes to tremendous lengths to restore the environment to the same, or in often cases, better than what it was. And as an industry, we have some legacy issues which we need to fix and address. And there's a number of mines as metal cycles, fluctuate up and down, which, were they to come back, would undoubtedly repair some of that legacy damage. And the water balance work that goes into these things to ensure that things stay on site, the thinking about landforms and visual appeal, it's de rigueur now when you go to get a mining permit that all of that is controlled and considered, notwithstanding some of the very real failures in areas we have to do better at, particularly with respect to some civil engineering and tailings dams works.
Well, it sounds to me that technology is continuing to expand. Things are getting better all the time. The world is starting to slowly embrace the reality that we need mines, we need the materials. That's not going away. So it's good to hear that things are coexisting, and it sounds like they're getting better all the time. Before we sign off, and is there any last points you'd like to leave our listeners with, or things that maybe I didn't ask that you wish I would have asked that you would like to sign off with?
Maybe for all the listeners, I can share one of my biases when it comes to picking mining and exploration stocks. When I am doing due diligence on these things, I have an overwhelming bias towards quality. It makes my life easier. When things are going up, I know they'll do well. When things go down, quality tends to go down less. It's very forgiving on my timelines. And, some people will talk about high grades. Some people will talk about massive tons or leverage. I keep coming back to quality and margin. That's what has served me well so far.
I'd encourage all the listeners that found this interesting to visit our website at sprottusa.com. And on that site, you can click on our firm and then click on site visits. And Justin does a great job of putting some of the most recent site visits on there. Some of those photographs are really pretty spectacular. I encourage you to go on our website, take a look at some of these most recent site visits, some of these photographs, and learn more about what Justin's doing at Sprott and some of the work we're doing as an overall firm. Justin, as always, I really appreciate you taking the time today to give a little insight to our listeners on kind of the world of mining. So thank you for your time.
Thanks, Ed. Always a pleasure.
Well, once again, I'm your host, Ed Coyne, and thank you all for listening to Sprott Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprott does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part, or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.